already started. This year, right now, we're at a critical inflection point in the economic cycle. And everyone is asking, as just mentioned, what's next for real estate? I want to use this opportunity to lay out where I believe we are and where I believe we're going. I'd like to start by walking through what I view as the state of the market from a macroeconomic perspective, and then from a commercial real estate perspective. And then I'd like to highlight the state of the market for healthcare real estate, student housing, and multifamily housing, areas where we at Kane Anderson Real Estate focus, and the generational investment opportunity that I believe exists today in these sectors. As I started my career as an investment banker in 1988, I've often said that I was a banker for 5 minutes and then a workout specialist for 5 years before I resumed being a banker again. I've lived through and experienced firsthand the economic crises of 1988, 1998, 2008, and most recently, the global pandemic. In the first 5 years of my career, I saw everything that could go wrong with real estate go wrong. And I was forever changed by the experience. Namely, I, and all of us at Kane Anderson Real Estate, recognized that there is significant risk and uncertainty in the world. And we spend virtually all of our investment time at Kane working to minimize downside risks while maintaining significant upside optionality. From this modus operandi comes one of my sayings: we are not risk takers, we are reward takers. In other words, we are always looking for asymmetrical reward-risk investment opportunities. Despite the significant uncertainty that exists in America and across the globe today, I am seeing an incredible investment opportunity set in front of us. We'll circle back to this shortly. But let's begin with a perspective on the macroeconomic environment in which we find ourselves, and then drill down into our sectors of focus. I'd like to show, and I guess it's already up, the 10-year Treasury graph. And this only goes back, as you can see, to the year 2000. Starting in 2008 with the global financial crisis, fiscal and monetary policies in the U.S. and around the world began an unprecedented era of easy money, which peaked during the early COVID recovery in 2021. In the U.S., this was effectuated with intentionality by the Fed post-GFC, when Ben Bernanke, the Fed chair at the time, argued to institute quantitative easing, or QE, a term that did not exist prior to 2010. There was significant debate within the Fed at the time about the ability, or lack thereof, to ever discontinue quantitative easing once put in place. The argument being that pulling QE once instituted would create yet another financial crisis, which would require yet more quantitative easing, which would send us into an endless spiral of fiscal spending. We may be experiencing that right now. Despite concerns voiced by many, Bernanke nevertheless prevailed with only one dissenting vote, and quantitative easing was born. I'm sure you are all familiar with the term, but the basic definition of quantitative easing, simply put, is increasing money supply to stimulate the economy. More dollars creates more demand for goods and services, which results in a stronger economy, yet one that is much more leveraged due to free money, which makes investors in the financial system more exposed to external shock. On the 10-year Treasury chart that we have here, we can see that the first time on this chart, the average 10-year Treasury yield pierces 4%, goes below 4% for an entire year, is 2008. And while this chart only goes back to the year 2000, I can tell you that the last time pre-2000 that the 10-year Treasury pierced 4% was 1962. So that's 46 consecutive years that the U.S. 10-year Treasury was above an average 4% yield. Now let's just take a look at 2011 to 2022. The average 10-year Treasury rate during those years was 2.18%. Clearly the era of free money. What have been some of the effects of this policy, and what does it portend? With respect to some of the effects of this policy, they include a moral hazard risk. Through quantitative easing, the U.S. government instituted a policy that resulted in historically low interest rates. This investment environment essentially forced investors, from individuals to pension plans to sovereign wealth funds, to take higher risks to earn an appropriate return. Think about a pension plan that needs to earn a 7% annual return to stay fully funded. When the risk-free interest rate drops from over 5% to slightly above 2%, that fund is forced to go much further out on the risk curve to earn an adequate return. But what investors learned from the GFC is that when there's an external shock, or when an external shock hits the financial system, the U.S. government will be there with bailout money. So no worries about taking excessive risk. The U.S. government has your back. And that is exactly what happened in April of 2020 in response to the global pandemic. We had a highly levered financial system due to historically low interest rates, and then we had an external shock that completely shut down demand for many goods and services. We were staring down the barrel of a loaded gun and looking at a potential collapse of the financial system a la 2008. The Federal Reserve had built upon its experience and expertise from the GFC and went bigger, faster. In fact, the Fed injected almost $5 trillion into the financial system, not the U.S. financial system, but obviously goes beyond that, in 1 month, which is roughly equivalent to the amount the Fed had injected into the American financial system in its previous 100 years of existence, inclusive of the GFC. Let me just say that again because it's a stunning statement. During COVID alone, the Fed injected more money into the financial system than in the prior 100 years. Number two, inflation. When the talking heads on CNBC and Bloomberg speak about inflation, it's almost always focused on price inflation. But the bigger story is asset inflation. As interest rates go down, asset values go up. The inverse of what we're experiencing in the economy now. As we've had a relatively dramatic rise in interest rates that has reduced liquidity in the system and recalibrated asset values down in a very significant way. So what does this tell us about where we find ourselves today, and what does it mean in the future? The short story is that the Fed finds itself in a precarious position, which has resulted from its policies starting with quantitative easing in 2010. On the one hand, the Fed wants to lower prices and inflation and demonstrate to the vast majority of working Americans that it understands the situation and is addressing it through tougher fiscal policy. On the other hand, bank balance sheets have taken a massive hit due to higher interest rates and declining asset values. Corporate debt is at record lows. Bankruptcy filings have escalated dramatically, and commercial real estate, especially traditional office, no surprise, which comprises approximately 20% of all bank real estate lending, has declined precipitously in value, putting bank balance sheets in a precarious position. Commercial real estate debt maturities exceed $1.6 trillion by year-end 2026, with the majority of that sitting on bank balance sheets. The result is predictable and obvious. Bank lending has slowed massively, and we find ourselves in a relatively illiquid credit environment. You can see from this slide. Herein lies the quandary, regardless of where the CPI or PPI, consumer price index, or producer price index, is the standard bearers for measuring price inflation. The Fed cannot risk a bank failure or failures that could result in a crisis of confidence that could quickly escalate into a contagion and draw the U.S. and the world into yet another severe financial crisis. Thus, it is a virtual certainty, as we all know, that the Fed will lower interest rates later this month and will continue to lower interest rates for the foreseeable future. Let's show one final macroeconomic slide. This is a very busy slide. This is the yield curve. But quite simply, what this slide shows, without studying, because that wouldn't yield very much, is that with only one exception over the past 60 years, that exception being 1967, that a negatively inverted yield curve results in an ensuing recession. So in 7 out of the previous 8 times, and we're in the 9th time now, we're an 87.5% hit rate, an inverted yield curve has resulted in a recession. So I ask, is a recession in the U.S. actually unlikely, or is it more likely highly probable? Now, I've been in the recession camp for quite a while, clearly the minority viewpoint, to which I and Leah Kane are very accustomed, because being a disciplined investor requires a minority viewpoint. As Warren Buffett famously said, be fearful when others are greedy, and be greedy only when others are fearful. Importantly, regardless of recession or no recession, the economic conditions today that are challenging, which presents what we in Anderson real estate